The neoliberal era is definitely over. We're now on a fast track towards a system that can be best described as state-sponsored capitalism. By definition, investors always confront uncertainty, but the very reason why we emphasize so much secular trend is because the last thing we want is to swim against the tide. And the paradox is long-term trends, long-lasting trends, are actually less difficult to identify than short-term trends which are affected by day-to-day and week-to-week noise in the market. For instance, the pandemic was a formidable accelerator in the sense that even the most dogmatic countries, when it comes to austerity, have abandoned austerity, at least temporarily and hopefully permanently, due to the required fiscal response to the effect of the lockdowns. We're losing free markets. Endogenous signals in markets, which are crucial for active management, are actually blurred by government policymakers' intervention. Today, obviously, if you look at the G7 government bond markets, rates are administered. In some instances, Japan is a case in point, they're even targeted, 0% at the 10-year maturity bucket. That has consequences across the asset class spectrum in terms of how asset behaves, correlation, and also the expected returns investor should be prepared for. Treating China as a separate allocation, as a separate asset class is key. They probably don't yet perceive how important the Chinese financial cycle will be. Today, they're still very much focused on the ECB and the Federal Reserve, but progressively over the next few years, they should increasingly take into account what the Central Bank of China, the PBOC, does or does not. So it's going to be a progressive transformation. They will also understand the merit of diversifying portfolio to include China as a standalone asset class. For instance, we've introduced this year a renminbi-denominated Chinese government bond as an allocation in our fixed income portfolio and multi-asset portfolio. And we think this is really something which brings diversification, which brings added yield, because one of the paradox post-COVID-19 is that China nowadays is the only major economy that is still pursuing conventional macroeconomic policies. The leading edge companies in the healthcare space are data companies. In this respect, by the way, China has a major advantage because data protection policies in China are not as stringent as they are in the Western world. But it's clear that the trend is towards leveraging healthcare. We see with COVID, the messenger RNA-based vaccine have first been models on computers before they were manufactured in laboratories for testing purpose. So really the entire healthcare industry, that's just one example, but the entire healthcare industry is moving towards managing data, being a data business. If you look at the market cap of the leading technology platforms, they are nicknamed the TerraCaps nowadays, and you compare this with the leading healthcare biotechnology companies, you see that there is still tremendous room for shareholder value creation in the healthcare space. So that's an industry that will undergo profound transformation, but the winners will win big. So for investors, there are three lessons from this. Number one, be mindful of secular trends. Swim with the tide, not against the tide. Second, spend time of the market. 100% of the performance is crystallized 20% of the time, but you have to spend 100% of the time in the market if you want to capture these 20%. Finally, credit risk premia remain attractive. For those who have fixed income allocation, be patient, diversify properly credit risk, and harvest that return.